Good afternoon and welcome this afternoon to Long Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Kevin Horner, 28 plus year veteran of the financial markets. He's there to help answer your questions along the way. Welcome to all of you, whether you are here for the first time or whether this is your 100th time in this particular webcast or any webcast. We're glad to have you with us. And if you're watching in the recorded version, we're glad to have you as well. Leave a comment in that comment section. Make sure you click on subscribe so that you get connected to the Trader Talks webcast community. If you're here in the live version, you've got the benefit of being able to ask questions, and Kevin's going to answer those along the way as well. I'm going to try to catch those as well. Sometimes it's a little bit difficult for me to see all of those questions, so be patient. If we do happen to have a question in the chat and Kevin doesn't get to it, and I'll try to get to it as well, and we'll try to answer your questions. Keep your part of the conversation. It's been an interesting couple of days. It's been an interesting week since we talked last. It was a little more bullish last week, a little bit perhaps more moderate today. We'll see what that looks like. We're kind of running into the tail end of earnings season as we get into things like Home Depot and Lowe's. Those tend to report late cycle, but we've also got some of the technology names that are still reporting in this earnings season, and that brings into the conversation this discussion of when do we enter long option trades around earnings announcements, and how does implied volatility percentiles, how does that play into the discussion? What are our expectations? I've got a couple of requests from some of you that came from our feedback survey in terms of managing some of these option trades. So we'll take a look at that as well as we get into this discussion. Remember that as we get into these housekeeping items, that everything we talk about simply for illustrative and educational purposes only. It is not any kind of a recommendation. It is simply for illustrative and educational purposes only. And when you talk about options carry a high level of risk that's not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. We're going to use technical analysis in this discussion. It's not a guarantee of future success out there in the real world. Neither is fundamental analysis, neither is probability analysis. All of those are theoretical in nature. None of those can predict the future. And so we're going to take them as pieces of information that help us to make a decision. Also, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. It is also not a guarantee of future success, but it is a great learning environment. However, remember that some things might be different when you move to a live trading platform than they are in the paper money version, including how orders may get filled and where they might get filled. Oftentimes, the paper money platform will fill at or very near the midpoint, whereas that may not always happen in the real world. Remember that past performance of any security or strategy doesn't guarantee future results or success. And when we are going long an option, when we are buying a call or buying a put to open the transaction, our theoretical maximum loss in the trade is the amount of the trade, the amount that we pay for the trade. So there is the possibility to lose everything that we have bought in a long option transaction. So let's jump out here to the Thinkorswim platform and take a look at what's going on. As Kevin brings up in the chat, the volatility index has backed off a little bit. The VIX has come back just a little bit, but the market has been moving. So what I want to do really quick is pop over here to my index grid, first of all, just kind of see what the indexes are doing. From the time that I started teaching this morning and started discussing this market, we've seen a little bit of a turnaround. The market has become a little bit more bullish. It's now up almost a full percent, 0.86, whereas the last time I talked about it in a webcast, in my trading futures webcast, it was down about 0.4 on the SPX. The NASDAQ up 1.25%. So a little bit more bullish day here, starting to see that RSI turning up a little bit higher here. And the Russell 2000 up a percent and almost 1.2% to the upside as we continue to move in that bullish direction, which is what we want to see happen here, right? We want to see indexes continue to move in a bullish direction, perhaps, if you are a bullish trader. If you're a bearish trader, this probably isn't helping very much. If you've got bearish positions on, long put options, a strong market probably working a little bit against those positions at the moment. One of the other things that I want to look at really quick while we're just in this particular space is I want to bring up the VIX, VIX, the volatility index. And the volatility index here seems to be falling a little bit. We were up at about the 21, high 21 handle. We're now at the 1933 level, seeing that moving back to the downside a little bit. That suggests that volatility is bleeding off a little bit. That doesn't necessarily suggest that this market, because the VIX is moving lower, that this market is reaching a level of complacency, because you can kind of see, if you were to draw a diagonal trend line here along that volatility index, and remember, this isn't a tradable instrument. The VIX in and of itself isn't a tradable instrument. So it doesn't behave in the nature of, relative to levels of support and resistance the way a tradable instrument would. But you can typically tend to see trends emerge, and there's a trend emerging here in the volatility overall, that volatility baseline where it returns to. That volatility baseline for the market as a whole is staying relatively high and getting a little bit higher in terms of where it returns back to. So normally the average for the VIX over the course of the last year has been in the 15, 16 handle. We are now in the 19 handle. And that suggests that there's just kind of an overall elevated sense of risk out there in the market, which is okay, but it presents a conundrum for long option traders, because ideally, as a long option trader, we want to buy an option when implied volatility is low and sell that option back, close that trade down when implied volatility has gotten a little bit higher as a long option trader. Because that long option is positively sensitive to implied volatility. It's positive vega, meaning that if implied volatility goes up, that works in our favor. The conundrum, the pickle in this particular case, is that if we were long a call option and the price of an underlying stock is going up, it typically is very rare to have implied volatility go up and have the instrument go up as well. It is typical, however, to have an instrument go down and have volatility increase. So volatility increases tend to benefit put options a little bit more, because that's kind of the typical nature of things. We don't, as investors, typically hedge against upside movement, but we do buy options for upside potential. So buying options, whether we're buying puts or whether we're buying calls, can elevate implied volatility. So if there is more activity going on in an individual instrument, buying calls and buying puts, then it's likely that implied volatility is going to rise. So that gives us a sense of what's going on in the market here, kind of as a whole. What I want to do now is I want to pop over here to our monitor tab, and we'll take a look at a few trades that we've put on over the course of the last couple of weeks as I've been filling in here for Rachel in this particular webcast. So the first one I want to look at is this one, this GE Verona trade, or Vernova trade, sorry. GE of Verona is probably one of the lesser known of Puccini's operas. GE Vernova is, on the other hand, a power generation company. Sorry, that was a bad opera joke. Anyway, so we put this trade on back on the 17th, looking at that long upside movement, looking for bullish directional movement here. And what we've seen in GE is that GEV in this particular case has gone up. It's currently, the stock currently is sitting at 875. So let's go over here to the chart real quick. And I'm going to put this on my single grid. And now Kevin's thinking, why in the heck is Ben talking about opera? GEV. because it ain't over till the fat lady sings, and we're seeing that price movement going to the upside here, right? We're seeing this rallying. The question in a lot of traders' minds is this the last act of the opera? Thank you, Marcus. I appreciate that. It's always nice to get credit for my obscure musical references every so often. And so we see this breakout to the upside here in today's trading. That has certainly benefited this particular trade. Now, here's the yes, Chris, 100%. You got it, my friend. You got it. So as we see this breakout today, that maybe suggests, as we look at this individual trade, that maybe there's an opportunity to manage this particular trade. Because as we go back to that monitor tab, we're getting a little long in the tooth here. We're now down to this 24 days to go until expiration. So we start to think about the influence of theta, the component of our option trade that references or that influences or suggests the sensitivity of the option to the passage of time. Yes, we've got a lot of delta, but now we've got we're very likely to have a higher theta as well. And this trade has gone from a $61 share price per share times 100 shares to a $93.50 share price times 100 shares. So it's made a pretty decent profit at this particular case. Now, there's no indication that this isn't that the opera is over, right? There's no indication that the singing is going to stop and this isn't going to keep going up. But at the same time, maybe we can do something here in this particular case to leverage the fact that this has gone deep in the money and it's getting closer to expiration, which means that we're going to be losing at some point the battle between directional delta and time theta component. So let's go to the trade tab here for this GEV trade. And here's our trade with 20 days to go until expiration, 24 days to go until expiration. And we are long the 800 strikes. So we got to go out a few more strikes here. So I'm going to go to about 50 strikes, which is going to be 25 up and 25 down. And okay, so for those of you that are coming into this particular webcast and saying, I don't know what's going on, what are we long an option? Here's where we are. We are long a call option, which means that we bought a call option to take advantage of directional upward movement. Being long an option suggests that we want the price of the stock to move in the direction that that side of the trade has. So a call option is bullish. And we want to take a look at this from a bullish perspective because we bought a call option. The price of the stock has been moving in a bullish direction. If we were bearish, we would have perhaps purchased a put or bought a put. We would have been long a put. We're bullish here. And a bullish option is going to have a positive delta. This has positive sensitivity to directional price movement to the tune of about 77 cents per $1 move in the underlying stock. So that's benefited us. And you see that there's a lot of increments. We've got $2.50 increments between a lot of these strike prices, $5 increments as we get further out on the chain. But notice what's going on with our theta component here. So we've got about a 99 cent or almost $1 of theta component at the money strike, the 875 strike. Further out here on the chain at the 800 strike, where we're at the 77 delta, we're deeper in the money in this particular case, that theta component has decreased because remember, it's going to fall off from the at the money strike. Theta is going to become less significant the further out of the money we go, the further in the money we go, because there's just simply going to be less extrinsic value far out and far in. So the nature of this trade changes, but we're still fighting a battle here. Here's the thing. If you look at this comparison, look at the comparison. 77 cents of price improvement if the price of the stock moves $1 to the upside, theoretically. That's a theoretical relationship. But for every day that goes past, we lose 80 cents. So we got about a 3-cent disparity there in between those two. So unless the price of the stock continues to make $1 upside every single day, at least, we're losing ground to time. If at best, right now, is this kind of backed off even a penny there, we're holding our own. So if the price of the stock were to move up $1, we're losing that dollar, or essentially we're losing that 79 cents to the passage of time. So we're in stasis at this particular point. Now, rolling it doesn't necessarily make that situation perhaps any better if we were to just simply roll to a higher strike at the same expiration. Because look at what's going on. We're getting down to 24 days to go until expiration. And if we were to let this go even further towards expiration, let's look at, say, for instance, the 6th March, we were to let this go another 14 days, another 2 weeks, and we get out to that 800 strike. In fact, we got to add a couple more strikes here. Let's add 10 more strikes, and that'll put us to the 800. Now you can see, even though our delta has increased a little bit, our theta component has increased as well. So now we're losing ground on a daily basis if the price of the stock just stays where it is. We're losing ground. If the price of the stock were to gain $1, we're losing ground. If it gains more, we're gaining a little bit, but we're still fighting the battle of time. And we're kind of at that point where the battle of time is inevitably going to win somewhat. So what we can look at doing in this particular case then is rolling in two directions, diagonally, if you will. Rolling out for more time and rolling up for greater leverage. But that's with the balance, right? We want to keep a little bit of intrinsic value, because remember, we talked about the idea of buying an option that has intrinsic value, because at the end of the day, this option is going to resolve to, at the end of its lifespan, intrinsic value or nothing, because all that time value is going to be gone. So we may want to think about buying an option that has a little bit of intrinsic value, so it has some inherent value component if nothing happens and time just passes. So we're going to look at going out. So it all comes back to the opinion. If our opinion is that the price of the stock is going to continue to move to the upside, we might throw, whatever other components into this mix that we want to. Implied volatility is relatively low and potentially rising. RSI is still high here. It's still moving and still moving up. We can still take advantage of this and at the same time book a little bit of what is at this point still unrealized gain in the trade. So what I'm going to do is I'm going to look at rolling this out. So if we think about where we might roll this out to, let's close down some of these expiration series. And so what we may do is roll this out and give it another month or so to continue to move. So I'm maybe going to look at moving out to the 17 April, right? Now, would I potentially start a trade in this situation with this breakout today? Yeah. With that breakout above that resistance level, if I were looking at this being bullish, yeah, I would consider that, because one of those entry considerations is a breakout trade, right? And we talk about 2 points at which you could potentially enter: a bounce up off of support or a breakout above resistance. And so this might be an entry scenario. And that's, I think, Octavio, a very good question to ask. Would I start a new trade at this particular point? And the answer here might be very soundly, yeah. It just broke out, and it did it with some emphasis here. It did it with some RSI momentum, with some oomph behind it. Again, this is an illustrative example, and I'm not making a recommendation here, so don't confuse my exuberance for recommendation. I like that, Kevin. Thank you very much. New highs are not bearish. That reminds me of a Steve Martin joke back when he was in his Wild and Crazy Guy album days, when he says, "I used to like to punt on first down." New highs are not bearish. Don't give away that momentum. So let's come back here and let's pop back into our trade tab and say, look, let's go out to the 17 April expiration. We'll give it another month worth of time. Because you don't know that Eric, we don't know that it's going to pull back tomorrow. We don't know. There is absolutely zero guarantee that it's going to pull back. And we might say, well, yeah, maybe there's going to be some profit taking. Yeah, there might be. And what if there's not? And then we've missed that opportunity. So we're going to look at rolling. We're going to stay with the original premise in this trade, which was bullish. So I'm going to come back here to the 52 days to go until expiration, the 17 April. And we're going to look at rolling this up to a little bit higher strike. And given this, given this opportunity here, we're going to roll this to a lower, slightly lower delta, but still one that has some fairly decent leverage to it. So what I'm going to look for then in this particular case, I'm going to look for the tightest bid-ask spread that I can get to, right? So Barbara asks the question, what point do I roll? When delta equals theta? Yeah, that's a consideration based on technical considerations, based on time. Generally, if we get down to that 20 to 30 days to go until expiration time frame, that's when a trader may start to look at rolling, simply from the standpoint of you're kind of getting to that edge of the curve where this is falling off the edge of that time decay curve, and theta becomes a much greater component. So you know what? As I look at this, yeah, next week one of us can say "told you so," but you know what? I don't have any other information, any more information about whether it's going to pull back or not than you do about whether it's going to pull back or not, because there's no guarantee what the price of the stock is going to do in the next tick, in the next minute, in the next hour, the next day, the next week, right? It could pull back, but it could keep rolling, rocking and rolling. And evidence to the contrary, it's got a strong RSI and it's breaking out of a resistance level. So it's got some momentum behind it. So here's the thing that I'm going to look at. 52 days to go until expiration, this 17 April, that doesn't have a lot of liquidity to it. I mean, I've got a fairly wide bid-ask spread. Now, to be fair, it's made a big move. So those bid-ask spreads may be increasing. So what I might do is I might come in a little bit to this 2 April, and then we could look at potentially rolling again. But that's going to get me awfully darn close to that same time frame where I would look at exiting again. And these don't have a lot more liquidity either, because that's just been listed. So remember, we talked about the idea of buying a little bit more time than we think we might need. So I'm going to do that. I'm going to look out to this 15 May expiration to see if there are tighter bid-ask spreads in this 15 May timeframe. And there just aren't at this particular point, which suggests to me that there is a little bit of volatility afoot. So I'm going to go back to that 17 April. And I'm going to say, all right, okay, let's kind of live with what we've got here. I've got a 96 to 99. I've got at the 840 strike, 84 to 87. That's a $3 difference. To be fair, this is an $800 stock, so I'm not terribly worried about those widths of those bid-ask spreads. I kind of like this one right here, the 66 or 65 cent delta, the 830 or the 840 strike right there. And we could book just a little bit of profit on this and roll this out for time and up for strike. So we're going to roll up $40 in terms of that strike price. Stock's still trading at 875, and we're still keeping. Yeah, if this weren't an $800 stock and I were seeing $2 or $3 wide bid-ask spreads, I probably would look at exiting the position and waiting for some of that volatility to calm itself down. But at the same time, if I can work this order a little bit and try to get inside that bid-ask spread, that gives me an opportunity to get inside that bid-ask spread. So in a live trading account, and that is the purpose of the market maker, and price improvement is to help work us inside that bid-ask spread. So what we're going to do in this particular case is create that rolling order, and we're going to roll to the 840 strike out to the 17 April expiration. So we're going to go back to our monitor tab, but delta equals theta. Yeah, and in that particular case, delta does equal theta, but we've got a little bit more leverage and we've got a little bit more time frame. So again, it's always a trade-off. There's always a balance to be sought. There is no one absolute rule of thumb that gives us an opportunity here. So I'm going to buy this calendar spread. We're not going to make it a calendar spread. We're going to make it, this essentially becomes a diagonal spread. So we're going to sell back the one that we are long to begin with, and we're going to buy the one out to the 17 April expiration, but we're going to go up a little bit in terms of strike price. So I'm going to roll this up, we said, to that 840 strike. And I can do this for a little bit of a little bit of a credit. So basically what I'm doing is I'm creating this roll, I'm accomplishing this roll, and I'm booking or realizing some of what are yet to be unrealized gains in the trade. So putting a little bit away, kind of locking that in, and then staying with the original premise that this continues to move higher and creating this order. So I'm going to try to work this inside. You see the width of that bid-ask spread. I'm going to try to do this for a little bit more credit. Let's see if we can get a little bit higher credit here in this particular case and kind of work that a little bit higher, bring in a little bit more premium for that roll. We're going to put it in our long options group. Now, remember, this is paper money. So this rolled and it actually filled us significantly better, kind of more towards the natural. Roll it for a credit or just forget it. Exactly, Dave. And I think that's a good point, Barb, and Chris and so forth, where I might consider to roll. If I can't roll this for a credit, I'm going to look at closing the trade down. That would be another reason to close the trade down, because there's either some elevated premium because of implied volatility or whatever other reason. I'm not rolling to the right strike price, but I'm looking for that opportunity. You can see how these spreads have kind of come back in a little bit. These bid-ask spreads have come back in. That benefited us in rolling this trade. So now we go back to our monitor tab, and we are long the 840 call and expecting that the price of the stock is going to continue to move higher, and we're going to benefit from that. So we've booked a little bit of profit on this trade, and we've kept the trade, the opinion, the bullish opinion of this trade continuing to move in that particular direction. Now, the other one I want to take a look at is this one. This is the CPB. This is the Campbell's trade. And CPB, Campbell Soup. But we had a couple of things going on for us here in this particular case. From the time that we put this trade on, we saw a move to the downside. And we saw an increase in implied volatility. Now what I see going on in this particular trade is perhaps a little bit of a bounce up off of a support level right here at about the 26 mark, and the RSI is starting to tick a little bit higher. And implied volatility is rolling over just a little bit. Implied volatility got back up to a point where it's relatively high, even relatively high relative to that April low from last year. So where could implied volatility go from here? Probably more likely to go down than to continue to go up. But all of that's worked in our favor. So this might be an opportunity, rather than rolling to keep the trade going, this might be an opportunity to exit the position and book this profit, and then look at exiting the trade or entering the trade again if it continues to move in a bearish direction. So let's go back to our monitor tab and see where we are for this CPB trade. And I think we placed two of these on CPB. We did one that is getting down again to about that 24 days to go until expiration. That's the 29 put. That's the time that we might expect to get out of this trade, just like we did out of the GE Verona trade. And we would look at potentially booking a little bit of profit in that trade. Not a guarantee by any means, but it moved in the direction that we wanted it to go. The other one that we bought, the little bit further in the money, but longer dated, 80 days to go until expiration. Time decay wasn't working on it as fast, but at the same time, neither was Delta. So that worked for us, but that also had a much higher component of implied volatility. So we got a little bit of a bump in implied volatility, not much of a hurt from time decay in this one, and not much of a delta bump with this going to the downside. So we're going to look at closing this one down. The March 26th, or excuse me, the March 20th expiration, 29 put. So let's go to the trade tab for this one, and let's go out to this shorter dated one, the 24 days to go until expiration. And this is our long put, and it's deeper in the money. It's the 77 delta. We can see that the theta decay is generally pretty consistent across these strike prices. And our Vega component is not very large in this particular case. So we're not getting a lot of bump as we get closer. Remember, Vega sensitivity decreases as we get closer to expiration. So that's just going to keep going down. That influence is going to keep going down. So a drop in implied volatility in this particular point is not going to hurt us all that much, but neither is a rise in implied volatility. That's not going to help us very much. So we're really left with a directional option that's deeper in the money, and not a lot of advantage to sticking with this, because this number is only going to increase. That theta number is only going to increase as we go further. So we're going to look at closing this one down. We've got a little bit wider. We've got a 20-cent wide bid-ask spread. We're going to look at exiting that position. So I'm going to go back to the monitor tab, right-click, and create a closing order. And we're going to try to work this in a little bit. I'm going to try to sell this for a little bit more than we might get. There's the midpoint. I'm going to see if we can work it up to about $2.25 to sell it, and work that inside that bid-ask spread a little bit. Click on send, fire that order off. You know, this is more likely than not to fill at the midpoint because it's paper money. But if you're trading this in a live trading account, working that order, it becomes an important component, trying to work that inside a little bit, getting a little bit better price for selling this, selling it for a nickel more if you can. The balance is, if it doesn't sell and you end up chasing it, you got to be aware of where it was that you could have gotten out of the trade to begin with, theoretically. So trade working the order works to your benefit if it works to your benefit. If it doesn't, if it means you end up ultimately getting out of the trade out of desperation at less than you were originally going to get for it to begin with, then maybe think about just putting that order in and waiting for it to do what it's going to do rather than chasing it. All right, so we're going to watch for that one to close. The next one, though, this other one that we're going to look at, let's go back to our trade tab here. And let's come down to this one. We've still got 80 days to go in this trade. It's got some leverage to it. It's 71-cent delta. That theta number is only a penny, so it's not hurting us. And we still have 2 cents, or actually 4 cents, 2 cents more than our previous one. We have 4 cents of theta. So if this continues to move, this is one that we might leave in place if our directional expectation is still bearish. If, on the other hand, our directional expectation has changed because of this bounce up off of this support level, and we think that this is going to move in a bullish direction. Look, you still have longer-term trends moving to the downside. The risk that you have is that implied volatility falls, and that far out in time, if we go back to the trade tab, remember, we've got more of a Vega component, that volatility sensitivity. So if implied volatility goes down, because it's now reached that high point and it's likely to see some selling pressure pushing that volatility down, meaning put sellers are going to come in and start to push those expensive puts down in price, well, that may work against us. Now, it's not huge. It is larger, however, than if we were to go down here to the 10 days to go until expiration. You can see at that same strike price, at that 30 strike price, well, our Vega component. And again, remember, these prices are going to be dynamic and they're going to be based on current levels of supply and demand. These are in pretty high demand. And so that Vega component is going to increase in this particular case, or it did increase in this particular case. But that is a little bit unusual to see that, because Vega sensitivity tends to go down as we get closer to expiration. So here we are, 30 days to go until expiration. There is no Vega sensitivity as we get down into that last week to go until expiration. We look at the 13 March, and we can see that that Vega sensitivity is a little bit more normalized at that 1 penny. Yeah, you're right. I would argue that you're probably right. We're not necessarily looking at this bullishly. So I'm going to leave this one alone. I'm going to leave this one alone and let that continue to move to the downside. So we've managed these two trades. We've put an order on to close one. We've put an order on to roll one that we did in the GEV trade. And we're leaving this one with 80 days to go alone. Now let's look at a couple of new trades as we kind of explore this idea here. So the one that I'm going to look at here is AKAM, Akamai. So let's go to the chart. AKAM, Akamai. And going back to Eric's point, in terms of a bounce, we had a pullback off of this earnings announcement. Implied volatility went down, but it didn't stay completely low. It kind of rebounded, but we got a bounce, a pretty nice, healthy bounce up off of this 50-period moving average. Not that that's going to be a guarantee that it's going to continue to move. And we're kind of right at a resistance level. But this could continue to make that move to the upside, maybe even up to this 113 or 114 range where that previous high was. So let's go to the trade tab. And we're going to look for a move in the short term and kind of move that to the upside. So here's Akamai. Now, this trades with a fair amount of volume, 2.6, 3.6 million shares average daily volume, but we notice we don't have weekly options here on Akamai. So our granularity is somewhat limited. So I'm going to go to this 17 April, 50 days, 52 days to go until expiration. We're going to look at this bullishly, and I've got fairly narrow bid-ask spreads here. I'm going to look at the 100 strike. It's trading at 103, so this one is slightly in the money. It's got a little bit higher delta. It's 63-cent delta. It's got about 6 cents of theta at 52 days to go until expiration, and it's got a pretty high volatility sensitivity. So if implied volatility starts to go up, that's going to benefit us. Now, could I spend less? Yes. What's going to happen? If I were to go to a further out of the money option, that's going to decrease my probability of success. This is a positive probability of success. It's not a coin toss. The 50-cent delta, it was the coin toss. The 63-cent delta means that there's a higher probability that this is in the money at expiration. Not a guarantee, it's a probability. If I were to go out to a higher strike price, lower delta, lower probability of being in the money at expiration, but a lower cost. So that's the trade-off. So we're going to look at this trade. I'm going to look at placing this trade with a little bit of intrinsic value, because if this resolves itself to not doing anything at expiration, I'm left with a little bit of intrinsic value. Plus, I've got some time value that I can sell back to somebody else. So I'm going to look at buying this 100 strike, and we're going to click on that price right there. Now, one thing before we do this, here's the expected move, about $12 plus or minus. That's based on implied volatility. We look at the chart. It's currently trading at 103. Where's $12 higher? That's about 115. Where is 115? Right up there, just about that previous high. So is that well within the expected move? Yeah. That's where we think it might go to based on that level of implied volatility. I'm cool with that. So I'm going to go to the 800 or that 100 strike. We're going to click on that 100 strike call option here. And we're going to try to work this in a little bit. See if we can pay a little bit less than $8. Let's see if we can pay $6.80, maybe even $6.75 for it. Click on confirm and send. We're going to put this in our long options group, and we're going to fire this order off and look at taking advantage of that upside move. We got it for $7.70 inside that midpoint of the bid-ask spread, which is good. Always work that order a little bit if you can and try to price improve that trade. Now we're looking for this price to continue to move to the upside. All right. Last one I'm going to do here really quickly is a potential downside trade, and that is on JetBlue, JBLU. I always like to do an upside and a downside trade. Why the April instead of the May? It's always that trade-off, CP. It is the trade-off between how much you're paying for the trade versus how much how much time you're in the trade. Is there enough time for it to make the move? Is it within that expected move? Yeah, so the fact that it was within that expected move, within that time frame, I'm fine with that. Now, now here's the thing. Would I put a stop on that? I'm not a huge fan of putting a stop on long options because it's already a risk-defined trade. And putting a stop on a long option invites the possibility of being kicked out of the trade on intraday volatility, and then the price continues to do intraday volatility of the option, and then it continues to move all on its own the way that you wanted it to move. But we'll go ahead and we'll put a stop loss on this JetBlue trade as we put this together, just so that we can see it. Because Akamai is bouncing up off of that support level. So now in this particular case, though, breaking down, we've got the 50 above the 200 and starting to roll over a little bit. We've got a little bit of a bearish trade going on here, a little bit of a bearish expectation, maybe a bit of a double top here. So we're looking at this from that perspective of a double top. RSI is diverging bearishly, implied volatility relatively moderate, with the potential to go either stay the same or go a little bit higher here. So we're going to look at the trade tab here for JetBlue. Trades with about 14 million shares, average daily volume. And by the way, what you're starting to see is these extended numbers here, those extended decimals, that's reflective of fractional shares being traded. Okay. So what I'm going to do is I'm going to go out again. I'm going to start looking a little bit beyond for a long option, the length of time that I think it's going to take plus some time. So I'm going to go with that 17 April expiration once again and look at buying an option here. Now those have a little bit wider. I might go to the June and see what the bid-ask spread is here. And I might go the other direction to that 2 April and see what the bid-ask spread is. Those are a little bit tighter in this particular case. So this is trading down to the point where we're probably not going to get a huge move to the downside, right? Because look, this is trading in this $5 range. We might see this move a couple of points to the downside. So I'm not looking for a big, expansive move. I'm looking for this move to move, maybe down a point or two. So I'm going to go down to this option that is fairly sensitive, higher delta. It's got a little bit more intrinsic value, and it's got a bit of a lower theta component. So I'm going to go to the 7 strike, and we're going to buy that 7 strike and expect that this is going to continue to move to the downside. Am I willing to lose all of this? Yeah, I think in this particular case from that standpoint. So I'm going to put this in our long options group. Let me edit that really quickly because I'm going to see if I can work this down a little bit, pay a little bit less than that. See if we can pay $1.37 for it, work that down. We'll put this in our long options group. We'll click on send and we'll fire that order off and we'll see if we get that. That may take a moment or two to work, but that's what we're looking at here in this particular case. What loss maybe make would get out of the trade? I might think about getting out of the trade if it loses 50% of that value of the option. But I'm also positioning sizing for that maximum theoretical loss. Here's where you're going to find more information, guys. And that order just filled for us. But come on over here to our Trader Talks webcast page. By the way, click on subscribe if you haven't done so already. And this is where you're going to find things like stops on options. Right there, stops on options. There is a comprehensive guide of how to place stops on option trades. There's Cameron May talking about it. There's me talking about it. Guide to placing option orders from beginner to advanced. Lots of opportunities for you to learn a little bit more about those ideas. My thanks to all of you for being here, whether you're in the live or the recorded version. I hope that you will meet us in San Diego this weekend. Kevin's going to be there. I'm going to be there. Kevin Hinks, Joe Mazzola, Kevin Green is going to be there. It's going to be a great time. Barb Armstrong is going to be there as well. Saturday, the Marriott Marquis on the waterfront right by the convention center. It is no cost to you. Come and join us for that event. We will see you Saturday. Take care, everybody. Bye-bye.